Have you thought of relocating in retirement, moving closer to your children or grandchildren, to a warmer climate, or maybe a more tax-friendly state? Hello, and welcome to today's webinar, Relocating in Retirement, where we will address these important questions, ones that we often encounter during the financial planning process. At this point, we have clients in approximately 35 states, and many of those clients living outside of New York started as New York clients and relocated for a variety of reasons, some during their working years and some during retirement. Often we help clients evaluate the pros and cons of changing their residency and quantify the impacts to their financial plans. Today's presentation will be conducted by two of our esteemed colleagues who possess expertise in this area, Nicole Goebel and Scott Strohecker. Nicole is the firm's Director of Financial Planning. She is a certified public accountant, a certified divorce financial analyst, and a founding member of our tax practice. Nicole is joined by Scott Strohecker. Scott is a wealth advisor with our firm. Scott is a certified financial planner and an enrolled tax agent, and is also a key member of our tax practice. Over the next 30 minutes, Scott and Nicole will cover the factors to consider when contemplating relocation. They will walk us through an income tax case study showing New York versus other states, lead a discussion on how to establish residency, and discuss a partial move strategy. I want to thank you for joining our webinar today and trust that you will find it informative and engaging. To start the presentation, I would like to introduce Scott Strohecker. Scott?
Thanks, John. The decision of whether or not to move in retirement really starts with a conversation between partners or spouses. While you may hear in the news or from friends about states without income tax, like Florida, Texas, to name a couple, and think that this is the perfect reason to consider a move in retirement, I'm going to highlight some other factors you want to consider when asking yourself the question, does it make sense to leave New York? First, there are social factors to consider. Who do you want to be with? While there are a number of ways to connect with family and friends using technology like FaceTime or Zoom, it's still very different from getting to meet with them in person or without having to jump on a flight to go see them. You also want to think about, what do you want to do in retirement? Also, what recreational and social activities do you have available to you and do you enjoy? And are they going to be in this new spot you're considering locating? You should also consider what environment you want to live in. Do you prefer the fast pace of a city with everything within walking distance? Or do you prefer the serenity offered up by a beach or mountain environment? Each environment also comes along with its own climate, so you need to figure out what is suitable for you and your loved ones. While a beach in Florida may seem like an appealing place in the cold, dark days of winter, you may not necessarily enjoy how hot and humid it is in months like July and August. Maybe the heat without the humidity is more fitting for you. Sometimes the arid climate of a desert is exactly what the doctor prescribed for you. Speaking of the doctor, you should consider some medical factors when making your decision. How accessible is quality healthcare? Some places may not have high quality healthcare nearby, so you want to make sure to check what is available. Do you have access to a caregiver? Often we rely on family to provide some level of care as we age. If you move away, who will you then turn to? What's your next defense to really provide that level of care that you need? And what could that cost be to you? Each state really varies when it comes to Medicaid eligibility. So if applicable, you should understand the differences in benefits, spending, and overall eligibility for Medicaid. In addition to these social and environmental and medical factors, you want to consider financial factors as well. Home prices can vary a lot based on several factors. On the current slide, you can see 4 different homes from across the country. While each of them are similar in price, what you get for that price is very different based on its location. You could spend, $500,000, $1 million in one place and, receive or purchase a large home with everything you're looking for. But if you went to another spot within the country, that money may not go as far. So really want to look at all the different factors when considering what you're getting for your money. You also need to consider the cost of insurance as well as the maintenance of the home. Finally, we come to taxes. There are 5 different taxes that you should consider when thinking about whether or not you should make a move. They are real estate taxes, personal property taxes, sales taxes, estate taxes, and everybody's favorite, income taxes. And now I'll let Nicole dive deeper into income taxes by going through a case study.
Thanks very much, Scott and John. So I don't know that income tax is everyone's favorite topic, but as John said, Scott and I spend a lot of time working with clients on this type of planning. So let's take a look today at a hypothetical couple retiring in New York State and the different considerations from an income tax perspective we want to look at if they're identifying different states they may want to move to. So Jim and Pam, 68 and 67, have recently retired from their jobs in the capital region, and they're considering whether they should move out of state. From an environment perspective, they do like the 4 seasons and hiking in the Adirondacks, but they believe New York could hurt them financially if they stay here during retirement. They have 1 adult child in Massachusetts. They have extended family in Connecticut. So from a social perspective, those are 2 states they may consider moving to be closer to family. Many of their friends are heading south to Tennessee, to Texas, to Florida, because their thought is their money will go further in these states and they can maybe get a little bit more, as far as purchasing a house. So while they're looking at all the different factors that Scott mentioned, social and medical and environmental, they want to know purely from an income tax perspective, what would it cost them to stay in New York State versus relocate to some of these other areas? Let's take a look. So for our clients, Jim and Pam, they have about $50,000 in Social Security income. They also have about $75,000 in other retirement income. In this case, we're using IRA distributions as that example, but that could come from a pension as well. And they do have a brokerage account that's generating about $10,000 between interest and dividends. So from an income perspective, they do have some significant income in retirement. From a deduction perspective, they are paying about $8,000 in real estate taxes. They still have a mortgage and are paying about $8,000 in interest each year. And they do make about $2,000 in charitable donations. So with this financial snapshot for Jim and Pam, we took a look at, well, from a federal perspective, what are their taxes going to be, and kind of our starting point for this example. So as we noted, there's taxable interest and also dividends of a total of $10,000. Then for IRA distributions, Jim is taking about $35,000 and Pam $40,000 for that combination of $75,000. And each of them also receive about $25,000 in Social Security benefits. One key item here is the maximum amount of your Social Security benefits that is taxable is 85%. So you'll see to the right that I do have the taxable amount of their Social Security versus that total figure. So in total, Jim and Pam have $127,500 of income before we consider income taxes. So that's a pretty good chunk of money. And of course, they could be using cash or money from their brokerage account as well. Because Jim and Pam do not have significant amount of deductions with mortgage interest or more taxes, they're taking the standard deduction for federal purposes, which for a couple their age is $32,300 this year, bringing their taxable income down to $95,200. It's important to note that this number may change in the future. Taxes are supposed to sunset back to pre-2019 numbers in 2026. So again, the standard deduction may change in the future, but we're doing this as of today, which should apply for the next couple years. So with that taxable income number down to 95,000, you can see their total federal taxes are about $10,500. So Jim and Pam are still in New York, so let's see what it looks like if they're staying in New York from an income tax perspective. Starting with the same amounts, the great thing about New York, Social Security is not taxable. We get to exclude that full amount of taxable Social Security at the federal level. So for New York purposes, that ends up being zero. Another advantage in New York is you get to exclude the first $20,000 of your retirement income for each person over 59 and a half. So of those $75,000 of IRA distributions, Jim and Pam each get to exclude $20,000. So that reduces their New York income by another $40,000. So really from our starting point of $127,000, we're down to $45,000 of income for New York purposes. For New York, you do get a standard deduction of $16,050 as a married couple. However, in Jim and Pam's case, they actually have deductions above that amount. So we can take a deduction directly for their real estate taxes, their mortgage interest, their charitable, totaling $18,000. There's other itemized deductions that New York still allows that are no longer allowed at the federal level, including tax preparation fees and investment fees that sometimes have an effect on your deductions as well. So in total, that brings our New York taxable income all the way down to only $27,000. So between deductions and exclusions, you've reduced your income by $100,000 for New York purposes. The result, you're only paying about $1,100 in taxes. So if Jim and Pam were only making the decision to save on income taxes, again, this is a hypothetical case, but I'd say pretty average retiree, it's only going to save $1,100. So I'm sure with relocation costs, the sale of a home, purchase of a new home, $1,100 is not anything to write home about. It's important to note that although the tax bracket for New York is 5.25%, again, because so much of the income is excluded, it's resulting in a very low tax. So if we move to a state with no income taxes, that may be again from a social perspective, environmental perspective, or a cost of living perspective in general would be better off. There are a number of states that have no income taxes, and so certainly could save that $1,100. So you can see here on our chart to the left, we have the 9 states currently with no income tax. Tennessee actually right now does tax interest and dividends, but that is being phased out. So some of them I don't know anyone would choose just from a financial perspective. I know we have one client in Alaska, but again, moving to Alaska, South Dakota, or Washington state, you'd certainly want to have other reasons to move to those states versus an income tax perspective. Again, warmer climate, also potentially lower cost of living, depending on where you're choosing. Could be Texas, Florida, Tennessee, Nevada. Again, Wyoming, again, I think you'd want a specific reason to move there versus saving that $1,100 in income taxes. And we even have one state in the Northeast, New Hampshire, if you wanted to stay up here, where we do still have the 4 seasons and lots of beautiful hiking, but want to save on income taxes. But keep in mind, as you see, there's a couple points on the slide here that these states need to make up their revenue in other ways. So whether it's higher sales taxes, whether it's higher real estate taxes, a higher tax on gas. You can see here, one item, if you're a beer drinker, Tennessee has the highest beer tax. But really, again, you need to think about that overall cost of living and what makes sense. On the right-hand side, we actually have, as of 2022, the top 10 states where retirees were moving. So some of them have overlap. As you can see here, Florida, Texas, Tennessee are actually on the list here as some of the states, as well as Nevada. But there's other states that certainly have income tax and maybe, again, more disadvantaged, have a higher income tax than New York, but people are moving there for other reasons, whether it's Arizona or South Carolina, North Carolina. So many of these we think are more from a climate and again, overall cost of living perspective versus income tax savings. There are other states that you could move to that, again, would not be as beneficial as New York, where we get the exclusions of Social Security as well as your first $40,000 of retirement income as a married couple. These are some key states to potentially avoid. As you can see here, these states actually tax Social Security income. So while most do not, Connecticut being one nearby, Rhode Island as well, and also Vermont, they all actually tax at least a portion of your Social Security income. So that's something key to highlight. Let's do a couple case studies of specific states that Jim and Pam may consider retiring to for other reasons. So first from Massachusetts. So again, their adult child lives in Massachusetts. Maybe their intention is moving there in the hope that they're going to have grandkids sometime soon. Again, just be closer to family. And it's not much of a different climate. So let's say all other things being equal, they look at just income tax, whether it's a savings or an additional cost to move to Massachusetts. Starting with the same numbers, Massachusetts also does not tax Social Security, so that's one benefit. So we get to take out that Social Security income. Massachusetts specifically gives you a deduction for charitable donations. So again, this couple is donating about $2,000, so we get to reduce the income by that amount as well. But then we take the numbers down and we look at, okay, well, they also get an exemption both for a joint filing tax return of $8,800, and because they're over 65, each of them get another $700. So those total deductions bring their taxable income for Massachusetts purposes down to $62,800. So not as significant a drop as New York, but certainly well below the federal level. So in this case, Massachusetts income tax is about $3,600. So really triple what they would be paying if they stayed in New York. Although the state tax bracket, you can see here, they're in the 5% marginal tax bracket, slightly lower than New York, because much more of their income is subject in Massachusetts to tax. They are still paying a much higher total number. Another place they would consider is Connecticut for their extended family. So starting again at the same point, Connecticut does tax a portion of Social Security income. For this specific couple, they get to exclude about $30,000 of that total, so only a portion of that is taxable. Also, Connecticut allows you to deduct 5% of your taxable IRA distributions. So again, not a huge savings, 5% of that $75,000 or $3,750. So Connecticut taxable income well above the Massachusetts number and more than double what the New York number is. The resulting tax, close to $3,400, again, almost 3 times as much as New York. So even though your state marginal tax bracket is 4.5%, you don't get a lot of the exemptions or deductions that you would in New York State. Lastly, I wanted to highlight another state where you would be better off from a financial perspective than New York. So Pennsylvania is one of the states that does not tax retirement income. So in this case, if Jim and Pam relocated to Pennsylvania for other reasons, their savings would be significant, certainly, and again, not necessarily a no income tax state, but close to it for their purposes. Social Security and their IRA distributions are both not taxable. So in this case, the only thing they're getting taxed on is that $10,000 of dividends and interest that they're receiving off of their brokerage account. That amounts to a whopping $307 for Pennsylvania tax purposes. And in this case, this client would actually get a tax forgiveness credit. So really they would net zero. So Pennsylvania is one of the states, again, that does not tax IRA distributions. This is something to consider if you do have a very large bucket of tax deferred assets where your required minimum distributions are going to be significant. Again, looking at states that exclude some or all of your retirement distributions would be something important to consider. So now that we've looked at the numbers from an income tax perspective for a variety of different states, and we've identified that again, for this somewhat average retiree couple, they're only paying $1,100 in New York, let's talk about what you would do next if you've made a decision to relocate. Scott?
Thanks, Nicole. So what does come next once you've decided and are ready to make the move? You need to work on establishing your residency, or more importantly, your domicile. Your residency can be changed very easily and depends largely on your time in a state. You can be considered a resident actually of more than one state at a time based on a number of factors, but you can only have one domicile. If your residency or domicile is ever called into question, some of the factors that are examined by an auditor are things like your home or where you own property, your business involvement, where you spend your time, and also how much time you spend there, the people you hold near and dear to you, like friends, also your family and where they are located. These are all factors that'll be looked at and examined by an auditor. So when you do actually decide to make the move, there are a few official changes that you will want to make sure that you make. These include updating your driver's license and also your vehicle registration, updating your voter registration, which in many states is automatically done when you apply for a new license. So you may be able to knock those two out together. You also should update your address with the IRS by using Form 8822. You simply are notifying the IRS of your new address. And also, finally, some states do have a declaration of domicile form. And if they do, you definitely should consider completing and submitting one just to really make sure you're crossing all the boxes to establish your domicile. If you're not ready to fully locate for whatever reason, maybe you still want to consider all the different factors that we've gone over today, you could consider becoming a snowbird to escape the cold. I know a lot of people do, again, during the cold days of winter, go off on vacation. So that this is one way that you could go try out a new place for a bit of time to see if you could see yourself fully relocating later on in retirement. You can also even just do an extended vacation any time of the year to a place that you may consider moving to see if it, really meets all of your needs and has all these different factors that you've considered, to see yourself living there full time. Now I'll just turn it back to Nicole to summarize and leave you with some of our closing thoughts for today.
Thank you, Scott. So just to summarize what we've talked about today, don't underestimate the impact of the non-financial factors. As Scott pointed out, the social, environmental, medical, these really affect your health and happiness in retirement. So again, don't necessarily make a decision purely for financial reasons. Make sure you're considering the overall financial cost to live in an area. So as we illustrated real estate, what you can get for your money in different areas of the country varies quite a bit, as well as things like insurance and taxes. Again, in some of the areas that may be closer to, for example, the beach, there may be significant insurance costs that really, again, offset any savings in lower real estate values. Take time to understand how different states will tax your income as a retiree. Again, certainly this varies from state to state and is very complex. So make sure that you know that before, relocating specifically to save on income taxes. Make sure you work with your financial advisor to take the correct steps when you do make a decision. As Scott said, there are various items to make sure that you're taking care of to establish your domicile. And try renting out in a new area. We never like to see someone kind of, making that leap and doing things as far as selling a home or purchasing a new home, maybe not at the optimal time from an interest rate or cost perspective, and then 2 years later feeling that they're not happy with the move they've made from, again, a social or environmental perspective. We often recommend, again, go rent somewhere for a few months. Make sure that it's an environment that has the resources that you want available to you in retirement. So we thank you today for tuning into our webinar. This will be posted on our website shortly. And please make sure you do check out our website, boucher.com, for other insights, our weekly blogs, our quarterly webinars, as well as these types of planning topics. Thank you again for joining us and have a great day.